The gas will go down. As soon as the war's over, it'll drop like a rock. There's so much of it. It's all over the place, sitting all over the oceans of the world. And it'll go down.
In a globalized world, wars no longer stay confined to battlefields. A missile strike in the Gulf can raise fuel prices in Europe, disrupt factories in Asia, and hit inflation in America. That is exactly what the Iran war is now doing to the global economy. What the world is witnessing is a deeper economic fracture, one that is exposing how vulnerable global trade, energy networks, and supply chains have become after years of overlapping challenges. On this edition of the Biz Lens, we dive into the long-term economic fallout of the Iran war. This war has triggered the biggest disruption to global energy markets since the COVID pandemic. Attacks on refineries across the Gulf, combined with the ongoing Russia-Ukraine conflict, have knocked out nearly 9% of global oil refining capacity. The impact has been immediate. Brent crude surged to nearly $126 per barrel at one point, a 4-year high, while jet fuel prices touched record levels. Global fuel markets are now tightening rapidly. Diesel, aviation fuel, and industrial fuel supplies are all under pressure, as refineries across Saudi Arabia, Kuwait, and Russia either shut down or reduce operations. Industry estimates suggest over 500 million barrels of oil have already been pulled from global stockpiles to stabilize supply. And even if the conflict ends quickly, analysts warn recovery could take months. That's because damaged refineries cannot restart overnight. Higher fuel costs are pushing up transportation, manufacturing, and shipping expenses across industries. Businesses are warning of shortages in chemicals, metals, fertilizers, and industrial materials that are essential for manufacturing everything, from cars to packaging. Europe is already seeing diesel prices hit record highs, while aviation sectors are warning of possible jet fuel shortages during the busy summer travel season. Across Asia, several countries have started energy conservation measures and fuel rationing to manage the pressure. Analysts say inventories have so far acted as a shock absorber for the global economy, preventing an immediate collapse in supply chains, but those emergency buffers are steadily shrinking. Companies and governments are now openly acknowledging risk to essential operations. Economists say the biggest near-term impact will likely be inflation. Consumers may not immediately face empty shelves, but they are more likely to face higher prices across fuel, travel, transportation, and consumer goods. And if elevated energy prices persist long enough, the risk of slow growth and recession could intensify, especially across vulnerable economies. While households and industries struggle with rising costs, some sectors are seeing record profits from the volatility. This includes oil giants including BP, Shell, and Total Energies that reported stronger earnings as energy prices surged. Major Wall Street banks also gained from elevated market volatility as investors rushed to trade commodities, currencies, and safer financial assets. Meanwhile, defense companies are witnessing yet another boom. The crisis is also accelerating another global shift, the transition toward renewable energy. The larger concern, however, is that the Iran war has arrived at a time when the global economy is already deeply fragmented. The world is still dealing with the after effects of COVID disruptions, the ongoing Russia-Ukraine war, inflation shocks, and weakening global trade flows. Now the Iran conflict has added yet another layer of uncertainty to an already fractured global economy. For more deep dive economic stories, keep tuning in to the Biz Lens.